Like banks exist to let people and companies keep their money safe and borrow when they need to. In the past, people sometimes rushed to pull their money out of banks because they feared the bank might fail. These were bank runs to stop this government's promise. If your bank fails, we will give you your money back. This is what deposit insurance means, a simple government promise to protect people's savings. But once that promise was made, banks started taking on more risks. They knew deposits would stay, even when they made bigger bets. So the safety net made it easier to push risk further than before. Before the great financial crisis in 2008, this pattern let risk-taking build up across the banking system. When the crisis hit, many banks were already fragile. After the crisis, governments responded with heavy new regulations and much stricter capital requirements, forcing banks to hold far more of their own money as a buffer. Here is the problem, these rules are tightest exactly when banks are already in trouble. If a bank's descendants do more in countries like Italy. Banks were too weak to raise that money, so they cut lending instead. This meant less credit for families and businesses, less investment, slower adoption of new technologies, and weaker economic growth for years. So the combination of protecting deposits and tightening rules had an unintended effect. It pushed them into panics, but it made banks shrink lending. A better approach would be for governments to focus on rating each bank's risk clearly and transparently instead of relying so heavily on rigid capital rules. If people and firms could see clear independent assessments of each bank's strength, they could choose where to put their money based on actual risk.